Are you in your 30s? Are you married? Then you are in the best time in the history of our country because you will make more wealth than your previous generations in many ways. And I mean real wealth, not nominal. Real wealth that is returns minus the inflation. So, this video is all about that. It's a short video. Watch it till the end. Little technical, but don't worry. I have simplified it. And if you, right now, from this moment onwards, if you are careful with your spending and your focus is on right investing in equities and SIPs, then you will create much more wealth than the past generations, including people like me. So stay on, watch this full video, and share your comments. If you've not subscribed to this channel, I encourage you to press the subscribe button and subscribe, because in this channel you will hear content for young families to build their financial literacy and to build their financial habits and grow their wealth together. Hi, I am Franky Fernandes. I am a certified financial planner and I'm also a marriage coach. My mission is to help young families to build their wealth and also to grow strong in their relationship, which is so important. I'm also the founder of Harmony and Money. It's a community for young families where I coach them to, to cultivate good saving habits, investing habits, grow and build their financial literacy, and I would become partners in this in the wealth building journey. And I share about this in my free webinar, which I conduct every week. Check the link in the comments and the description. Click the link and join the free webinar. I teach the 3 secrets to grow your wealth and your marriage. And I also introduce my community there, Harmony and Money. Okay, so let's get back to the video and take your pen, notebook, sit together and watch this. This will be interesting. So for today's video, I'm going to show you, as I mentioned, I'm going to take you through the BSE Sensex from 1990. We'll see how the Sensex has grown over these years, what returns it has given in terms of compounded annualized returns, and at the same time, parallelly the inflation. What is the inflation? Because this is a very important number. Your returns from the Sensex are not the real returns, they are nominal returns. The real returns are the nominal returns minus inflation. And that is the real return. And that's a return which is so, so important. And I'm going to share with you today how, how the real returns are growing because of the falling inflation. And what does that mean to you and to me, especially you who are young? For us, for me who is in my early 50s, probably I may not gain because I've already invested and my gains will be much less compared to yours if you're in your 30s or your 40s. So let me share with you my screen and we'll take on from there. When the Sensex was around 600, and today it is around 81,000, right? So this is the way the Sensex has grown. But what is more important is the compounded annualized returns. And that is what we're going to look at it in a short while. And here is the inflation, the India's annual inflation taken from RBI data from 1990 to 1994. So if you see here, most of, until early 2000, it was always high. It was always 14, 10. So average around 12%. In in early, maybe a little before 2000 and maybe 2007 or 8, when here is where it is low, but otherwise it is always again high. It has fallen here. Then during COVID, it was slightly high, and then now it is falling. So this is the inflation. But when we compare it with the returns, we always look at the average inflation over the year. So let me share with you. This is an important chart, and I want you to understand this. Don't be overwhelmed. Just take some time to understand, and this will help you to actually estimate what could be your returns going forward and why I'm saying that this generation is fortunate. Now, this is forward analysis. Basically, it means I'm looking at data from 1990 to 2000, 1990 to 2005, 1990 to 2010. Basically, from 1990, I'm going ahead like this. So it could be 2000, 1990 to 2000, and so forth and so on. So that is the way I'm looking at it. So in 1990 to 2000, the returns, the CAGR returns for the 5 years was around 14%, close to 14%. And the the average inflation was around 9% average inflation from 1990 to 2000. And then this is the real return, which means the annualized returns minus inflation. So the real return was quite low. If you see here, the real return is just 4%. And for 1990 to 2000, 10 years, the Sensex returns, CAGR returns is around 13.6, little less than 4. And the average inflation was so high. From 1990 to 2000, right? The average inflation. And then if you see here, the, the, the CAGR return of Sensex is up and down. But what is more important is this is going down. See, it is going down. So this is what is going down. And here, the real returns is up. It went slightly down because the returns were slightly lower, but now it is going up. It is in the upward trajectory. And the simple reason why it is going up is, if you can see here, the average inflation is going down. 1990 to 2000, the inflation was 9. 1990 to 2010, as it progressed, the inflation went down. Cumulatively, if you see, it is going down, it is going down. Here it is slightly up, but it is only going down. And because of which, the real return from 4 to, yes, 6 here, it is high because the market had gone up here, this 10 year, um, this 20 years actually. And here, if you see here, 5.7, 4.85, and 5.6. So the key number is here, and the inflation is going down. This is a key number. And if this, and the real return is basically as a result of the market minus the inflation. So this is very important number. Now here, the markets have, in the 10, 20, 30, 40, 35 years, the markets have averaged 12%. And when this goes down, the real returns go up. Now, this is the forward looking. And the reason I have made this forward looking is, just assume that somebody invested in this period. Somebody invested in this period. They would have got 13.63, but the inflation was high. They would have got just merely 4.5%, and they would have gone out. Probably that was their retirement, or they wanted to withdraw. Just imagine somebody is invested in 1990, and for 20 years they stay invested. See the returns. Simply because the returns are high, and here the inflation is also going down. So whoever has invested since 1990, right, they have got a decent returns of around more than 5% real returns. And because they stayed on, they were rewarded because the inflation has going down. Okay, so this is the forward looking. Okay, so basically people who have retired in 2000, 2010, 2015, 2020, or 25, this is what is the returns. Um, Looking forward. Now, the next slide, which I'm going to talk about, is the backward looking. Now, why did I create this backward looking? It is for a lot of you young folks who have been investing. In fact, I've also actually started my SIP since 2011 or so, right? So for people like us, it helps to go back and see what have been the returns. Now here also, if you see, now here we are going back from, uh, if you see from 2025 going back to 2020. So see the returns. The returns are around 15%. Average inflation is low because it is coming down. It has come down. And if you see, if it is coming down. So, but see the real returns. So in the last 5 years, your real returns have been very high because markets have gone up from 2020, since 2020 to 2025. Inflation was low, And because of that, the real returns, which means your markets have gone up, you have spent less because of less inflation. Of course, inflation means a lot. We're just talking about the CPI. We're just talking about that CPI basket. Okay, the inflation has been low, so your real returns have been high. That means a lot. Your spending has been less, and if you planned your goals, financial goals, last 5 years, and if today you want to withdraw, you'll get far more returns. If you had predicted that the inflation was 5-6%, and based on that, if you had computed, so today you would have got much more. So in the last 5 years, you've gained a lot. Now let's go back from 2025 to 2015. The real returns have been this. This have been the real returns. And from 25 to 2010, the real returns have been so much. And here, if you see here, from 2025 to 2010, 15 years. CAGR is low. That's the reason your return is low. But if you see here, the inflation is high comparatively. Here, the inflation is low. That means in the last 5 years, last 10 years, the inflation has been low. But in the last 15 years, the inflation has been relatively high. It has been relatively high, above 6.5%. So if you had started investing in 2010, your returns have been less. If you had invested in 2005, your returns have been less, if you see here. If you had invested in 2000, your returns have been less. If you had invested in 1995, your returns have been less. Except for this, where the returns were high, actually the returns have been low. The the returns have been going high from the last 5, 10, 15 years. So what does this tell us? This tells us that in the last 5, 10 years, the returns have been good, the real returns have been high, just because the inflation has been coming down. And right now, the inflation is around 2 to 3%. Right? We have seen inflation of 7, 10, 12% also in the past. But now, in the last 10, 15 years, our average return, our average inflation has been low. And in the last 5, 10 years, as you saw the numbers, the inflation has been low. So what does this mean for the future? So I'm sharing my understanding, my interpretation, and my hypothesis. So what does this mean for the future? So in the last 10 years, the inflation has been low and coming down. So inflation may stay low in the future, and that is what is the the endeavor from the government, right? The endeavor from the government is to keep it low, and there are number of factors which will help us to stay low, unless something like COVID or anything like that happens. Looks like the inflation may stay where it is. It can't go like 10, 15 like earlier years. Stock market returns have been 12 to 15% on average in the last 20, 25 years. So it may continue to give around the same. Now, this is again a hypothesis. This is again an estimation based on how the markets have performed. So it goes up and down, but on an average, it may continue. So what does that mean? That means the real returns are therefore going up. And if the inflation stays low or goes down, in fact, the real returns will be higher. Now, if the real returns are higher, they'll be higher in the future compared to the past. And that's what I said in the beginning, that this generation will earn more in terms of returns simply because the inflation is low. And if inflation remains low or even comes down as we get better and better as an economy, and as India becomes the third largest economy by 2028 or 2030, and as it has been predicted by some of the large financial institutions, and they've said that it is India's decade. So I'm expecting that in the next 5 to 10 years, we will continue to do well. And if we continue to do well, which means our returns will be high, inflation will be low, and then the real returns will be higher. But I don't know how long this will remain. And that's why I said this is the time, this is the decade, we must do it soon. So that means if you are planning for your retirement, your financial goals, retirement, and the children's education and their wedding, marriage, etc., all that, all those goals, if you're estimating now at a higher inflation and you're expecting returns of 12 to 13% and you're expecting the inflation to stay high, maybe 4 to 5%. In reality, if the inflation stays low, your real returns will be high and you will have far more retirement corpus than you expected. Because currently, from now till, which means from now till your retirement, your spending may be less comparatively. Your returns could be higher, so the real returns will be high. So that means your corpus will be larger than what you expected. And even your retirement years, if the inflation remains low, you stand to gain because you have a larger corpus now. Yes, so you will be able to save more for all your financial goals, and also your corpuses will be larger. So this real returns is what will make the difference. But I really don't know how long this real returns will be higher. And this is, again, as I said, this is my hypothesis, this is an estimation, this is my understanding. So this generation is honestly a fortunate generation because you know that you have to invest in equities because of all these videos and financial literacy. So you will invest in equities. And the returns will be high, returns will be comparatively higher. And what I'm talking about is the markets. So the mutual funds will continue to give maybe 16, 18, 20%, obviously more than the markets. So your real returns will be high. And therefore, the wealth that you create will be much higher than the previous generations, including my generation. I hope I hope you've got the point. And as I said, you can only think about the next 5, 10 years. I don't know beyond that how will the country shape into. I'm hoping that it will only get better, but we don't know the future. So you must hurry up in accumulating your your equities right now. Increase your SIPs, increase your lump sum investing, reduce your spending to a don't waste into buying things on EMIs. The more you do, you will lose this great opportunity. So I hope I was not too technical and you have understood what I was trying to say. And if you are good at numbers and you think this analysis lacked something, please let me know in the comments. In any case, let me know in the comment box. What do you think of this analysis? Did you understand it? Could I have made it simpler? And if you have understood it, do you think this analysis really makes sense? Let me know in the comment box. Feel free to criticize. Feel free to let me know how you feel. Uh, but the fact of the matter is that you must invest, stay invested, do your SIPs, continue to invest in the equities through mutual funds. Yes, if you're good at stocks, this is the time that you pick the right stocks and do your investing, long-term investing. And all the best. That you hope that you will gain more and more. And if you're new to this channel, I encourage you to subscribe. This video is dedicated to all those who subscribe and those who watch this, and also my community, Harmony and Money Hub community members. So this video is for you. Hope you will capitalize on this knowledge and continue to stay invested and increase your investments. All the best, and I'll see you soon.